Hey everyone, welcome back to Noob Selling Options. I am so pumped to bring you today's explainer because, well, we're going to unpack the mechanics of a truly wild beast that's just roaming the market right now, Destiny Tech100, or as you probably know it, DXYZ. If you've been glancing at the charts lately, you know this thing has been on an absolute roller coaster.
But look, we aren't just here to gawk at the volatility. We're going to break down the exact rationale and the strict mechanics behind a high-yield options trade I recently placed on this ticker. We're going to talk about capital efficiency, implied volatility, and how to position yourself safely when the rest of the retail market is, frankly, just purely speculating.
Okay, let's just quickly glance at our roadmap for today. We've got Welcome in What is DXYZ, Unpacking the True NAV, My DXYZ Put Trade, Swapping SOFI for DXYZ, and the final takeaway. All right, let's get right into it.
So, before we get deep into the weeds of options jargon and premium collection, let's lay down the foundation. Section 1, Welcome and What is DXYZ? Okay, so DXYZ is a closed-end fund. Its massive selling point, the reason everyone is talking about it, is that it gives everyday retail investors access to late-stage private venture-backed companies. We're talking about the unicorns that are normally locked tightly behind closed doors, right? Companies like SpaceX, OpenAI, Stripe, and Epic Games. But here's the absolutely crucial point. Because this fund trades publicly on the NYSE while holding illiquid private assets, its public stock price can wildly, and I mean drastically, disconnect from the actual mathematical value of its underlying holdings.
To truly understand the trap that retail traders are falling into right now, we got to look at the math. Section 2, Unpacking the True NAV.
If you pull up a standard stock aggregator, like Robinhood or Yahoo Finance, you're likely going to see an audited net asset value of $19.97. That's the baseline number from their December 2025 annual report. But actually, scratch that. If you dig into the SEC filings, specifically the updated at-the-market prospectus, the updated NAV as of March 2026 is actually $24.56. So why the jump? Well, because the fund recently deployed massive amounts of cash, including roughly $100 million into Anthropic. So to be completely accurate, we absolutely must base our math on that $24.56 figure.
But honestly, even using that updated higher NAV, the math is still staggering. With the stock dropping down to around $35.80 recently, the market is still demanding a 45.8% premium. Just think about that for a second. If you buy the stock at market value, you're essentially paying $1.46 for every $1 of actual underlying assets. It's wild.
And this brings us to a really hard reality check. Why has the price been facing such massive downward pressure lately? Two main reasons. First, the at-the-market offering overhang. They have an active framework to sell new, dilutive shares directly into the open market, which naturally pulls that inflated price down. Second, and this is just crazy to me, between 31.4% and 46% of the fund's portfolio is currently sitting in flat cash equivalents. I mean, paying a 45% premium on SpaceX is speculative, sure, but paying a 45% premium to hold flat cash? No way. That is a fundamental gravity that inevitably pulls the stock price back down toward its fair value.
So, knowing all this, how do we actually capitalize on it? Let's transition from theory to execution in Section 3, My DXY Put Trade.
Check out the exact trade receipt right here. I sold the July 17, 2026 30-strike put for $3.10 credit. And I am incredibly satisfied with this fill. It's essentially weaponizing the absurdly high implied volatility of the stock right now. Instead of buying into the hype, we're basically becoming the casino and selling the fear.
Let's break down the actual mechanics here. The strike price is set deep out of the money at $30. The premium collected is $3.10, which translates to a clean $310 in total cash deposited immediately per contract. If you subtract that $3.10 premium from the $30 strike, your net break-even sits at $26.90. With the stock trading in the upper 30s, this setup provides a massive 25 to 30% downside cushion. The stock can completely crater by a quarter of its value over the next month, and this trade still doesn't face any actual capital loss.
But here is why the math truly works in our favor. Let's look at the absolute worst-case scenario. Let's say the stock slides downward aggressively and I get assigned the shares at expiration. Well, my net entry price becomes that break-even of $26.90. Remember that true NAV we discussed earlier? It's $24.56. That means, at worst, I'm acquiring a high-quality private equity portfolio of SpaceX, OpenAI, and Anthropic at just a minor 9% premium. It offers extreme protection from the 45% retail hype trap while still letting you play the volatility. It's a win-win.
But a trade like this doesn't exist in a vacuum, right? You have to manage your overall portfolio buying power. That brings us to Section 4, swapping SOFI for DXYZ.
This is what we call an implied volatility swap. I had open short put positions on SOFI, but the reality is SOFI's implied volatility is massively lower. If I wanted to maintain a 25% downside buffer on SOFI, I'd be picking up absolute pennies, maybe 15 to 25 cents per contract. DYXZ, on the other hand, had insane risk pricing. So by closing the SOFI puts, I took a very minor $15 scrape, essentially just a toll fee, to completely free up my buying power. That allowed me to shift over into DYXC, capturing over $100 more in premium while still keeping a deep, highly protected $30 strike.
And this brilliantly illustrates the concept of clean slate margin control. Step 1, you clear out the low-yield margin that's just spreading your buying power thin. Step 2, capture that massive premium credit that a volatile ticker like DXYZ offers. Step 3, immediately establish a 25% plus break-even cushion. Cutting the tail end of your portfolio like this keeps your maintenance margin clean, it prevents unnecessary stress, and it provides immediate return on capital. All right, all of this strategy ladders up to our core lesson today. Section 5, the final takeaway.
Ultimately, this explainer is really about textbook execution when dealing with highly speculative assets. Options trading isn't just about trying to maximize your win rate on every individual setup. It's about strategically managing your risk parameters. By selling the put deep out of the money, we completely avoided that 45% retail premium trap. We effectively weaponized time decay and the inevitable IV crush that happens when wildly swinging stocks finally start to stabilize. And most importantly, we optimized our return on margin through a really smart tactical rotation.
So I want to leave you with a specific, strategic question to think about for your own portfolio. When you structure a heavy premium trap like this one, do you plan to ride it all the way to expiration to pocket the full $310? Or do you have a standard rule to buy it back early, maybe at a 50% profit target, the very moment that volatility finally crushes? Managing the exit is just as critical as managing the entry. Let me know your personal rule down in the comments below. I'd love to read them.
And that wraps up our deep dive into the DXYZ disconnect. If you found this tactical trade breakdown helpful and you want to see more real-world applications of capital efficiency and risk management, make sure to hit that like button and subscribe to the Noob Selling Options channel. It really helps us keep bringing you these detailed explainers. Keep your margins clean, manage your risk, and I will see you in the next one.